Welcome to the Tech Talks Daily Podcast, where you can learn and be inspired by real-world examples of how technology is transforming businesses and reshaping industries in a language everyone can understand. Here is your host, Neil C. Hughes.
Welcome back to the Tech Talks Daily Podcast, where every day we explore how technology is transforming our lives, business, and even world. And while we're doing it, I also hope we can get experts on this podcast that have enjoyed an amazing career in tech and get them to pass on their insights and their wisdom so people listening can avoid making unnecessary mistakes. A phone conversation that is beamed around the world that then helps a startup founder or business leader anywhere across the globe get ahead or a competitive edge. That is why I record these daily tech interviews. So thank you for coming along for the ride. Let's level up together. And today's guest is in many ways tech royalty because Bryan Stolle is one of the founding partners at a company called Wildcat, where he focuses on investments in FinTech, EdTech, SaaS companies and technologies that address elder care. But he also has an inspirational story too. Growing up under two generations of self-made businessmen, Bryan's work ethic and entrepreneurial spirit is deeply rooted in his youth, and that's something that I wanted to try and learn more about today. For example, as a teen, he competitively raced motocross, taking on jobs, delivering newspapers and making pizzas, all to support his racing passion. But as a serial entrepreneur, Bryan has created more than $1 billion. Yes, $1 billion in liquidity for his investors as a founder. He oversaw the creation of go-to-market and market growth product and service offerings that has achieved more than $2 billion in revenues and raised more than $1 billion in venture, public market and investment management capital. But for most people listening, they'll know him as the founder and CEO of Agile Software, where Bryan led the creation of a new category now called Product Lifecycle Management. He led the company through the public offering and secondary offering that raised over $500 million to executing almost 24 private and public merger and acquisition transactions. And finally, steering a major strategy shift that led to the eventual acquisition of the company by Oracle. Let's just say Bryan knows a thing or two about the world of tech. But what if you could tap into his mind and learn a few things from a man like that, who has vast experience? Well, good news. You can, because Bryan is currently waiting in California to speak with us today. So enough from me rambling on and overdoing the scene setting. Let's get Bryan onto the podcast now. So a massive warm welcome to the show. Can you tell the listeners a little about who you are and what you do?
Sure, happy to, Neil. I've been in the startup game since my MBA at UT Austin. I was involved in 3 different startups, 2 as a member of the leadership team, and the third as the founder and CEO. That last one, Agile Software, was a B2B software company that created a new category called Product Lifecycle Management. We went from starting the company to public in about 4.5 years, entered into and then terminated a $3.5 billion merger with Ariba, and eventually we were acquired by Oracle. At that point, I pursued a different career as a venture capitalist, first at a long-standing stalwart VC firm, and then since 2005 as a co-founder, along with Bruce Cleveland and Bill Erickson of Wildcat Ventures, an early-stage investor who's primarily focused on B2B and B2B2C startups, very much early stage.
Wow, you have quite a rich history there. And although this is a tech show, I must admit, I do enjoy exploring the very human story behind a tech leader's journey. So can I ask that you share with me your story and how it all began as founder and CEO of Agile Software way back in 1995, Silicon Valley? It must be an incredible experience.
It was. And went through some very interesting times over that period of time. I think it's a story very familiar to many in Silicon Valley. I had spent a good 10 plus years at a startup, a company, really diving deep into product information management challenges and issues and consequences at manufacturing companies, most of them global 2000 type companies. And in that process, spotted some very clear needs and unmet opportunities. And it also became pretty clear why existing solutions, be them paper or spreadsheets or whatever else was out in the market, were really missing the mark in solving or addressing these specific issues that we had spotted. And when I brought it to the CEO, he really wasn't interested in pursuing it. We just had too many other things on the plate. It's a very typical story, right? Yeah. But I thought there was a pony in there. And so I went through several informal explorations with different teams and different approaches. And on the third iteration, decided to pull the trigger with a great team and a collaboratively designed solution that we were getting some pretty strong positive feedback from potential customers who we were just having informal conversations with. And so we quit our jobs. We refined the idea for several months while doing independent consulting work and just trying to put food on the table. And then raised some friends and family and angel money, set up shop at an incubator, software incubator in downtown San Jose, and started building a prototype with constant feedback from a set of potential customers. And 4.5 years later, and about $25 million in venture capital from Sequoia, Axel, Mohr Davidow, and Roger McNamee, we went public with almost 1,000, mostly global 5,000 customers. Eventually hitting a high of about $5 billion in valuation, several $100 million in revenues, and returned well over $1 billion to our venture investors.
Wow. I'm curious, though, how do you go from that work and into venture capital? Can you remember what inspired you to take that particular route?
Yeah, Neil, I think it really went back to grad school. I've always had an entrepreneurial bent. I always just sort of felt like or knew I was going to start a company or be involved in some kind of thing like that. Maybe because I came from a line of entrepreneurs and independent business people, my father, grandfather, et cetera. And then, in grad school, started to learn about this niche corner of the financing world called venture capital. Especially back then, it was a pretty small, clubby kind of place. And I just found it very intriguing. The linking of the capital and the support of these entrepreneurs and startups who are changing the world. I was fortunate because at the startup I was working at the time, Dick Kramlich, who was one of the founders of NEA, was on the board. And I cornered him after a board meeting and asked him, say, Dick, so what's it take to become a VC? This looks kind of interesting. I think I might want to do it someday. And he basically said that, if I wanted to be a great VC, go do something first, on the startup company side, ideally as the entrepreneur. So I followed his advice, and with the capital I accumulated through my last startup, which went public and obviously was successful, I started angel investing. So putting in my own capital in relatively small amounts. I don't think it was usually $100,000, couple $100,000 into a number of different startup opportunities, different entrepreneurs I met, and it's a great way to learn about investing from the investor side, especially since it's your own money. So you're learning on your own nickel. And because of that, I think you really learn discipline and to be thoughtful and to do your homework. And in a way that takes a lot longer, if ever, compared to people who start out investing with other people's money. So I just think that initial training where it's your money and it really matters and it's your capital that you're going to lose as opposed to somebody else's capital you'll lose, I think really helps hone sort of those investing instincts and skills.
Excellent. And we will have many startup founders listening all over the world and looking to learn from a few of the lessons that you've learned along your journey. And one of the questions I've got to ask is, what inspired the Wildcat team to write Traversing the Traction Gap to show entrepreneurs why certain startups succeed while others fail? Is there a story behind that?
Yeah, there very much is. It was really two things. One, as entrepreneurs and operators ourselves, we were well aware of the failure rate in early stage venture, in part because most startups are founded by first timers, many of whom often don't even have team building or management experience. So, this isn't something where you go into it and you know how to do it from the beginning. Most entrepreneurs are very much, learning on the job. And so, that's one thing that really contributes to sort of the mystery and therefore the failure rates of early stage startups. And then second, and what really kind of launched the effort is sort of the spark, if you will, was we kept hearing the same thing from our entrepreneur buddies and from prospective entrepreneurs we met. And they'd say something like, we just got back from Sand Hill Road, which is where many VCs are located, many of the U.S. VCs are located. And they say they love what we're doing, we should stay in touch, and come back when, quote unquote, we have more traction. And we were hearing this traction word over and over again. I talked to a VC and he said, you need more traction, or call me when you have more traction. And of course, no one could define what traction meant to the entrepreneur. So it's okay. So come back when I've got $1 million in revenue, or I've got 20 customers. Well, when you get more traction, come back. And so there's a lot of frustration because they were accomplishing things, they were making progress, but no one would define for them, what success looked like, or what were the metrics they needed to have to be able to raise more capital. So we really dug in on this apparently growing trend, and others have also, there's other things, you can go Google this, and there's other things that have come out about it that have been labeled things like the Series A funding gap or other things. But we came to realize is that all of the money chasing, because of all the money chasing the venture asset class, it was causing the size of investments to increase. And as the dollars got bigger, the investment dollars got bigger, investors, naturally became less tolerant. It takes a lot of courage to write a $20 million check to a person that has, is just sitting there with a smiling face and a business plan. And so the investors become less risk tolerant, and they want to wait later and later in a company's life cycle to invest, and then to wait basically until the company, quote unquote, has traction. And, what's interesting too is, we started this several years ago, but it's kind of a moving target, because when we started the traction gap work initially, it was around $5 million in annual recurring revenue. If you were a SaaS company, software as a service company, for example, was kind of where, the mark was. Now it's more like 7, 8, even 10 million. So it continues to move as money continues to, probably too much money continues to flow into the venture class. So that was really kind of the two impetus for us to go really dig in this problem and understand what was happening.
So if we do have any startup founders listening that want to learn from the pitfalls that so many before them have fallen to, are there any mistakes that they should avoid that immediately spring to mind?
Yeah. That's a very long conversation.
Yeah.
In fact, it's so long that we're actually working with several universities, including Babson and Columbia, for example, who are actually building full semester courses based on the traction gap. But that said, it starts and it ends with team. Great teams figure out great markets, great positioning, great go-to-market strategies, great solutions for market needs. Recall, as I mentioned earlier, I started Agile with a third team I assembled. So getting that team right is really important. It's not easy, and you really probably shouldn't go spend a lot of your time and energy on something until you've really got a great team to go after the problem. Second, to paraphrase Warren Buffett, go after what you know. Huge amounts of investor dollars get incinerated while too many entrepreneurs learn about a market they really don't know or understand. They've got great technical skills, or they've got some insight because of a personal thing that happened or whatever, but then they go chase a market that they really have never been in, have participated in, or understand. And so there's a lot of capital that gets spent educating them. And, at the end of the day, all too often, they end up finding out there is no market, or they find out the market is just so hard to penetrate, and the financial or psychic ROI is so low that you end up spending way more than $1 to earn $1, and that formula isn't going to change with scale. And then third, I'd say be thoughtful, but be decisive and move fast. Time literally is money at this point. Very, very expensive money, by the way. Venture capital is very expensive money. You give up a lot of the company for, at the end of the day, a few $1 million, give or take. So that's expensive. So the faster you engage with customers, the faster you're going to learn about what really matters. So I'll leave it with those three to start with.
And the other $1 million question I must ask on behalf of founders, and sure you must get this a lot, and I'm positive there ain't no easy answer, but how can a startup make themselves look more attractive to venture capitalists?
Well, I have several blogs on this, on Forbes and other places. They go into this in much more detail. But first and foremost, do your homework on market sizing. Entrepreneurs we very typically don't do enough work on this. So really understand your market and the size and the potential size. The better you demonstrate a grasp on your market and the opportunity and its potential size, the more interested an early stage investor would be. Second, at the risk of sounding like a broken record, present an amazing team. This doesn't necessarily mean well-known executives, technologists, or entrepreneurs. It means people with demonstrated skills, demonstrated proficiency, and performance in their area of responsibility. And the more you've also built an ecosystem of advisors and supporters around the team, the more convincing and exciting the story becomes for an early stage investors. You can remember, investors are people too, and they, like anyone else, they can be influenced by who you're associated with, perhaps too much, but nevertheless, the company you keep does matter and can influence how they think about you. Third, show why your insight or your contrarian view on the risk or the opportunity is true. So really help the investor understand why this opportunity exists and why it would be lucrative to go after it. And then fourth, clearly articulate and to the maximum extent possible, show why your solution is uniquely positioned and differentiated to take the market.
And another thing that I love about what you're doing here is the Wildcat team speaks at universities, accelerators, and incubators, and he's speaking to entrepreneurs in the general public. But can you share some of the core principles that you codified and discuss in the book, and tell us a little bit more about that book too?
Yeah, there's a number of them, but if I kind of back it off to a little bit higher level, first, to quote Peter Drucker, or at least this quote was attributed to him, culture eats strategy for breakfast. And I'll add lunch and dinner to that quote. It's one of the first things I dig into with entrepreneurs if I decide I like the basic premise of what they're doing. Culture matters that much. And again, it's all about the team at the end of the day, and culture is a huge part of building a sustainably high-performing team. Second one is listen to the customer. Then listen some more. Ask the next question. Ask why like you're a 4-year-old. Just dig and dig and dig and just get really deep and understand the customer's needs, their aspirations, their constraints, and their realities. And when I say realities, we see far too often somebody comes in and says, I'm going after this problem. And you look at it and go, yeah, that's a real problem. It really exists. But either because of just, whatever's happening out there in the market today, perhaps it's their specific solution approach, but usually it's often just because the market, it's just not practical from an adoption point of view because of political issues, customer inertia, friction, whatever it is, you just can't get from here to there. So really, really understand this problem and what it would take for your customers to adopt and why they would adopt and what they have to overcome to do it, and then build that into your product offering. And then lastly, you figure out what metrics define the health of your business and religiously monitor them. For example, one of the things Rally did, one of the companies that I investor in, was to measure some early usage stats for new customers. And they did not count a new registration as an official customer, even after they had paid, until that new customer, that new person, that new account had hit key usage metrics. Until then, sales still owned the account and was responsible for it. And only when they hit those key metrics did they hand the account off to customer support and declare them a customer. So really understand the metrics that matter in your business and really build, systems and processes around those things.
Now, you've also invested in many enterprise software startups that became industry leaders, and Cooper, Cabbage, Rally Software are just a few that spring to mind. But I'm curious, again, what did you take away from those experiences?
3 guesses. Team, and team.
Yeah.
Great cultures.
Yeah.
In one case, it was a strong entrepreneur who was leading the charge. He had fabulous background, had done almost every job reporting to the CEO before they became the CEO. So they were very prepared to be the leader and the CEO, and also had a great chip on their shoulder and just a great motivation to go be successful. In 2 others of them, it was a tandem or duo, and in both cases, the 2 people had clearly defined roles and responsibilities between them, both hard and soft. And I really emphasize that soft. It's not always just, you're responsible for sales and marketing, you're responsible for product development and customer support or whatever. They were very, very clear on the soft responsibilities. And they had complete alignment between themselves. You could find no daylight. You ask one a question, you get exactly the same answer from the other person. And they had very strong alignment, not just between themselves, but the broader leadership team. So, I'd say it's really at the end of the day all about the team and the culture, and great things happen from that.
And we are at that time of the year, of course, where people are starting, or tech futurists are starting to gaze into their crystal balls and trying to work out what's next on the horizon. And not only 2020, which seems absurd even saying that out loud, but of course, a new decade too. So,
oh yeah, it is, isn't it? I didn't thought of that.
It's Blade Runner territory, isn't it? But I mean,
yeah, it's a lot of territory. Back to the Future, we're already past that.
Yeah. So what further technology disruptions do you see on the horizon for enterprises, and how can they begin to prepare and ensure they don't get left behind?
Well, I guess what I'd say is they better already be preparing, or it may be too late. It is all about this. The new buzzword, if you will, is digital transformation, or DX.
Yeah.
And basically just digitizing everything in the enterprise, but more importantly, applying intelligence to those digital transformation projects, meaning machine learning, artificial intelligence, et cetera. A buddy of mine, Toby Redshaw, who heads up innovation at Verizon, was quoted recently as saying, and I told him I'm going to use this all the time because it's so good. He said, "If you aren't all in on AI, you will be deader than disco."
I love that. I might have to use that myself.
And it is true. I mean, there's a lot of stats out there you can go look at from, the McKinseys and the Bains and the, those kind of folks of the world. But, some pretty staggering numbers already and what companies are spending to go out there and, transform their businesses digitally. And by the way, this is going to take a long time. It's not something you just buy something and you're done. This is a multi-decade transformation that's going to happen. But, some stats like 30% of the global 2,000 by next year, are going to be spending, 10% of their revenues on digital transformation. It's just, one of many stats out there you can see. So, it is all about really reforming your business, taking costs out of your business with all these old arcane processes, and becoming just extremely close to your customer, really understanding your customer, becoming close to your supply chain and really understanding it and what it needs and how it works, and being able to link those two things so that you can just have this, hyper efficiency, that everyone's out trying to achieve with digital transformation.
Well, a huge thank you for joining me today. I genuinely appreciate it. But before I do let you go, could I ask that you remind everyone listening of where they can find you online, more details on the book, of course, and how to contact your team if they've got any further questions?
Sure. But a good place to start is wildcat.vc. That's the homepage for the firm, and there's a lot of the traction gap information is there on that site, and also links to other sites. The book is available on Amazon, so you just Google traction gap or traversing the traction gap or Bruce Cleveland in the bookstore on Amazon, and you should be able to find it one of those ways. You can find me at BD Stolle on Twitter. And if you go to my LinkedIn profile, I have most of my blogs posted there. And of course, I blog regularly on Forbes Online, so you can find a lot of information there. And quite a bit of it all of it has to do with startups for the most part, and the startup, process, and a lot of it specifically around the traction gap. And then there's a number of different articles and videos and whatnot that my partner Bruce Cleveland, who was the primary author for Traversing the Traction Gap, where he discusses the traction gap. So just Google his name, Cleveland like the city, Bruce, and Traversing the Traction Gap, and you should be able to find lots of articles and videos, etc.
Well, I'll add a lot of those links to the blog posts that will accompany this podcast over on my site, techblogwriter.co.uk. But I've spoken to founders in Germany, Vietnam, Israel, Moscow in the last week alone, which kind of proves that technology really is transforming the world and creating opportunities for everyone. But I think conversation like today's are so valuable in helping that next wave of entrepreneurs and startups. So I cannot thank you enough for coming on and sharing your wisdom and insights with me today. Thanks again, Bryan.
You're very welcome.
I just love the line there. If you are not all in AI, you're going to be dead as disco. But like Bryan said, this change is going to take decades, and the real benefits are not going to be realised overnight or in 2020, despite what all those crystal ball gazing tech trend articles will tell you. But you can begin to prepare for it now. And I believe today's conversation, combined with the blog post that will accompany this conversation over on my website, techblogwriter.co.uk. Go to podcast, you'll find today's episode, and I'll post all the links to all those resources that Bryan mentioned as well, just so you've got one place that you can go and start doing that research. So please check out all those links and let me know what you thought of today's conversation by simply emailing me, techblogwriter@outlook.com, or tweeting me at Neil C. Hughes. And a huge thank you to Bryan for taking the time to come on here and share his valuable insights and his experiences. And an even bigger thank you to each and every one of you that allow me to bombard your podcast feed with a different interview every day, and for joining me on this crazy journey called life. But that's it for today, so thanks for listening, and until next time, don't be a stranger.
Thank you for listening to the Tech Talks Daily Podcast with Neil C. Hughes. Remember, technology works best when it brings people together.